All right, how's it going, everybody? Welcome to Chapter 4 of the program Quantum Stocks, Chapter 4 Risk Management Continued and Trading Psychology 101. So, if you will remember from Chapter 3, we went over the Excel file with you, talking about position sizing based off of the total amount of what is in your account. uh, Looking at the various risk factors, your 2R, 3R, and 4R, and so forth. 2R being your 2-to-1 ratio, 3R being your 3-to-1 ratio, 4R being your 4-to-1, and then so on. We also showed in the Excel file um, going in on a certain percentage, risking no more than 1% of your total account. And if you are up 3R and the price of the stock drops down to your 2R profit target, a time to either scale out or exit the trade. So making sure we go to that, because that is going to be an extremely important concept, as well as a practice to implement for the duration of your trading career. You can always improve on that Excel file, but that should hold as a foundation for you. What we did not cover in the previous chapter, and then we also looked at how to set that Excel file to help um, communicate with Thinkorswim, following those same strategies and principles that we talked about, that was given within the Excel file. So what we did not talk about in the last chapter was looking at the different types of risks that are involved in trading, and then a little bit of trading psychology that is extremely important, because psychology um, can ultimately lead to also blowing up your account if you don't have the right mindset when you're trading. So we're going to spend a little bit of time on this um, chapter here going over that. We have about a 20 slide deck. This is one of the dry chapters, so to speak. Very little of looking at the Thinkorswim platform here. We want to get through the concepts, and this is quote unquote a boring section, but it is extremely important for you to understand as a trader and as you progress throughout your trading career. After this, we have the different types of the following subsequent chapter. Chapter 5, we'll look at stock patterns, and we'll look heavily at Thinkorswim and have a little bit of animation in there for you. But this one's definitely a dry one. But hang on with us. They are still important concepts, and there are still things you need to note. So make sure you have your pen and pencil, and paper, whatever you use, ready to go. Take some valuable notes, and we will get going. Okay. So with that said, let's go into the next slide deck here. So why is this important? Why does risk management even matter? Um, what? Why do we care as day traders, right? And it matters a great deal. Without the proper risk management, like I showed you in the previous chapter, if you start to have your risk variable, that will lead to um, your win ratio suffering. And the fact that with a 2-to-1 ratio, you'll need to be accurate 33% of the time. Anything more, you break even. If, and here's the caveat, you're consistent in terms of your profit targets and your loss in terms of value, not just percent. And as you saw in the previous chapter, when we changed our value that we were going into the stock, ultimately changing the stop loss to, instead of minus 500 to minus 2,000, it caused us to be negative 500 out of the 10 trades we took. Even though our P&L in terms of win to loss percentage stayed consistent, where we had 40% accuracy. So it's extremely important we have a good understanding of risk, and then what are the factors that play into risk as we are trading, and we're going to cover those here. Okay. So what does risk look like? Okay, if you think about it, traders think about risk, but gamblers think about profits. Okay, do you have any mental stops when you're taking your trades? How much are you risking in the trade? Um, and so forth. I'm not going to read line for line here on the slide deck, but you get the idea. And we talked about this in the previous chapter as well. Having a hard stop to protect you when you're in the account, having mapped out where to place those stops properly, so you don't get stopped out too soon, and so on. And as the saying here goes on the top, traders think about risk, gamblers think about profits. The goal of trading is not how much profit you can make. Well, let me rewind and rephrase. The only goal of trading is not how much profit you take. It's also how much you're able to minimize your risk. That is the sole focus as a trader, is how much risk you can minimize, and when you are winning, let those winners win to maximize on some profits. Okay, if you only solely just think about how much you're going to make per trade and never calculating that risk, you're going to find yourself in some trouble. So here's the different types of risk, and we're going to cover each of these. There are 9 types in my opinion. Some people say there's only 5, or whatever the case. I think there's 9. Exposure risk, float and volatility, distance from your stop and share size versus your profit target, halt risk, allowing fear to prevent you from your plan, the impulse to double down, the impulse to try to get revenge after a loss. Okay, so snowball effect. Following people on social media and chat rooms that don't know what they're talking about, and improper position sizing. These 9 things are the types of risks that are involved every single trade and every single day as a trader. And we need to be able to identify them, so then we can work on improving ourselves within respect to these. Okay, so let's look at exposure risk. What is it? And let's define it a little bit. So exposure risk is really simple. This is calculated by the amount of money you have in a trade multiplied by the amount of time you're in a trade. Okay, which for us, as a day trader, we think, well, we're only in the trade for a very short time, a matter of 5 minutes to an hour to whatever the case, but we're done at the end of the day. And this allows us, yes, to minimize risk in comparison to holding long-term on some stocks. However, even within a matter of minutes and seconds, the price of a stock can go away from us. So again, making sure we're setting those proper stops. And that's going to be a theme you hear throughout this entire thing. Set your stops. Okay. I've been trading since 2009, and I can tell you, for a matter of fact, of all the people that I have mentored, of all the people that I have worked with, and having learning myself going through the years, setting those proper stops and limiting the exposure risk is very vital to your success. Exposure risk is if I'm in the trade and I've already made my PT and it's starting to shoot up, and there's something, and I'm going to get into psychology on each one of these slides, there's a piece of greed that kind of takes over. There's 2 main psychology factors when trading: greed and fear. And exposure risk is a good example of both. One, on the upside, when that price of the stock is moving towards that upside and you're trying to maximize on that profit, maybe your goal on the day was to make 20% and you've already made well more than that on one particular trade. A lot of the times I'll see people having bent their rules on the profit target, and as a result, all of a sudden, that stock that was at 20% quickly drops down 10%, and then another percentage until finally you're back at your entry point, and then ego comes into play, and now you're waiting to see if it'll make a move back towards that upside, and then all of a sudden it starts to crash. And now you've been in this trade for 15 minutes, and had you taken out within the first couple of minutes, you would have walked out with profit. But now that you've, one, had a little bit of psychology of trying to get more money, so greed playing a factor, and then two, the fact that it's going down now, and now you're fearing losing money, so you're in the hopes of it to make a reversal for you to break back even or make some profit, is also now playing a factor. And now what should have only been a 5 to maybe 15-minute trade has now been an hour trade. And in some cases, what I have seen from some people ends up being a day trade, holding it long, a swing trade, excuse me, holding it longer than the day. Sometimes people hold it a month. And I've seen in some cases somebody hold a losing stock for a year, in which they were fortunate enough for it to then get back to break even after that entire time. But that entire time, the money was doing nothing for them. So minimizing the exposure risks, generally try to keep that exposure risk under a 30-minute of total hold time. If it is a super bullish stock that is moving towards that upside, minimize it to no greater than 30 minutes. Okay. And I hope that it makes sense. Again, you could always rewind, rewatch, and always feel free to send me a message, or anybody on the team on some more clarification on that. Okay. The next is float and volatility. So as short-term traders, we crave volatility. We want things to be volatile, especially for small and short, small cap stocks. Okay. We don't make any money when stocks are only moving, 1 to 2%. We make stocks that when they move 10, 20, 30% and 80% pre-market, right? Those are the stocks that we look for. And we find those daily. Maybe not so much the 80% movers, but definitely somewhere between that 10 and 30%. And these stocks will have a low float under 100 million shares, and sometimes as low as 1 to 10 million shares. So that's what we look at. Now, this means that we, again, have to be mindful on the max loss that we can face when dealing with these stocks. And again, going back to, and these all build on each other, going back to exposure risk, when you have a stock that is extremely volatile and is all of a sudden jumping up from, being consolidated at a certain price to all of a sudden jumping up 20, 30, sometimes in some cases 50% within 5 minutes on a chart, you need to understand and be able to identify and realize that it's extended. It could be extended, meaning that the difference between your moving average to your price of the stock is going to be great. And remember this piece, because we'll get into this once we start looking at some of the more advanced chapters when we're talking about pullbacks and things like that. And I'll come back to this so that we can relate as you start to build on these chapters. But with volatility also comes volatility, not in the form of just potential profit taking, but also potential losses, in which I've had cases for my own instance when I've got in on the trade and within a matter of seconds hit my stop loss, which is fine because I had the stop loss to protect me. But had I not, I've had and seen people that took the same trade as myself and did not have their stop loss, and instead of something being a small 5% loss, turned out to be something north of a negative 50% loss or greater. Okay, one, going back to the exposure risk, I'm trying to hold longer, and then two, the initial move towards the downside was extremely great. So There is risk involved when dealing with small caps. That's why we try to minimize that risk with our hard stop. Okay. 3 is going to be the distance from the stop versus the profit target. Okay, and if you remember from the previous chapter, I said that I use a 2-to-1 ratio. My 2-to-1 ratio is a 10% profit target with a 5% stop. Okay, we talk about this in depth in the previous chapter, so go back and rewatch. But I also mentioned that we can adjust that stop. Instead of being a negative 5%, could be a negative 7, a negative 10, and maybe even a negative 15 if you truly wanted. However, if you have a negative, let's just go with a negative 10. If you have a negative 10% stop loss, that means your profit target needs to be 20% in order to keep the 2-to-1 ratio. Now, not every stock is going to make a potential 20% move. So we try to be a little bit more realistic in how we set that 2-to-1 ratio. So that's in reference to here. If you have a huge distance from your stop versus your profit target, you can find yourself in some pretty big trouble. Also, if you have the inverse of where you have a 5% profit target and a 10% stop, I would have no idea why you would do that. But you're also leading yourself to a big risk there as well. And understanding what your max loss on a trade should be. So again, no greater than 1% of your total equity. The way I have it set up in the Excel, our risk is even less than 1%. Our risk is 0.5% of our total equity, based off of that Excel sheet I sent to you. And having an understanding of a max risks per day, in which is essentially anywhere between 2 to 3% of your total equity, in which if you hit that max on the day, you need to be done for the day, close your laptop and walk away. And we'll get into FOMO here in a second. But all of these things are really important. And again, this is a very dry PowerPoint, but it hits on some very key concepts to note. Okay. And again, capping your losses. If your 5% is set to be at $50, if you hit $50, you better be out of the trade. Definitely, I would give myself, depending on, you're never going to be able to get an actual perfect match in terms of your percent of what you're willing to go in on the trade and your stop. Meaning, if you have a $10,000 account, then what you could put in per trade would be 1,000, in which if you hit your PT would walk away with 100. But depending on the price of the stock, $3.33 doesn't go evenly into $1,000, right? And then thus there's going to be a little bit of variability, but you should be relatively close to that target, that price. Okay, so that's what I'm referring to. It's never going to be a 100% match, but as long as it's really tight. So I would not expect, if your stop loss was supposed to be at around 500, for you to lose more, anything more than 550. Okay, anything more than that, you're way outside and you need to cut it out. So I give myself a couple of dollars in leeway for that. Now, again, capping those losses is extremely important. When we don't cap, when we don't have a consistency, it leads to ultimately potentially blowing up an account. Okay. And a good example of trading is like skiing. When you ski, you're going to fall, and falling is inevitable. You have to learn in a controlled way so you don't get hurt. The same thing applies here. We're going to lose more than we win. Trust me on that. But we're going to be profitable daily if we stick to that Excel file. Or a similarity of that Excel file. It doesn't need to be exact. Okay. And then again, always know what you stand to lose. Have a max loss on the day in terms of a goal. Okay. And then again, we talked about the 2-to-1 ratio, so I don't need to go over that here. We talked about it in the previous chapter, so again, making sure we go back. Another piece that we haven't quite touched on is trading halts. You will see this more as the chapters progress and more real-life examples on these. A trading halt is essentially if a stock is going towards that upside and it's moving extremely drastic, it can undergo a halt, which will then get paused for a period of time. During that period, typically if it's a halt towards the upside, it'll continue to go towards the upside, in which you could take, which ends up being good. Some cases, though, a halt that occurs depending on the news as to why it got halted, or especially if like there is some manipulation or something like that, when it resumes after undergoing that halt, can then lead to a drastic downturn. And depending where you got in, if you got in prior to the halt or you placed an order to get in right after the halt, could lead to a huge drop in price. So trading halts, I would say, are neither, depending on the type, and there's various types, and I'm not going to cover all of those here, can either be good or in majority of the cases can be bad, especially if it's a halt towards the downside. And again, typically, and this is just typically, if it's a halt towards the upside, it will resume towards the upside if there's no manipulation being involved. A halt towards the downside will resume towards the downside. Okay, and that's just how the flow typically goes. But again, that's typical. And there are times where it breaks through those and become atypical. Okay. Number 5, allowing fear to prevent you from following your plan. And we're going to get into a little psychology here. If you have a strict set of rules already, you already have covered your metrics, and this is actually another good piece that we need to go on, and which was also on that Excel, where I have a trading log for you to start mapping and tracking those trades. There's also various websites in which you could do this from as well. But it's extremely important to track and start to trend the data that you have as a trader. Not only the price of the stock, not only your profit and loss, not only how much you go in per trade and what your profit target and stop loss should be. You should also be mapping out the time frame in which you're most successful, the day in which you are potentially more successful, and then going back to that time frame, are you better at trading the open within the first 15 minutes? Are you better at trading the intraday between 8 before the power hour? Or are you better at trading the power hour? And then are you better at trading a certain sector, a biotech, healthcare, oil, et cetera, and you really start to map out all of that statistical information and really start to see where you are most successful based off of those statistics, and start to build a trading plan around them, so that you can have a higher probability of being successful following your trading rules, your trading plan, and proper technical analysis and position sizing. And when we don't do that, when we don't have that type of plan and those type of statistics to help us, they're a natural fear, because when you don't prepare, you prepare to fail. Okay, so that's the one thing that will help lead to you losing your account is not preparing, which also by not preparing, you're going to be fearful, right? If you had a presentation to present to your boss and you didn't prepare on it at all, you're definitely going to be fearful when the day comes and you have to present and you don't know what you're doing. The same thing is here. If you aren't truly prepared, fear is going to play, and it will prevent you from following any type of plan that you may have thought would have been a good setup. Okay. The other part of that fear is not managing that risk properly, not setting up and sticking to that Excel in some form or another. It doesn't need to be exact again, but not having that, where I've seen people, they're scared to press the button to buy or scared to press the button to sell because, in a matter of fact, they're fearful to lose, where you can't be, you're gonna lose. So you need to get rid of, just like, I don't know if you ever anybody here has ever played football or any type of contact sport. There's always that fear, or even boxing, for example, there's always that fear of that first punch that comes to your face, or that first time you're in have the pads on for football and get your first crack. There's always that small little doubt, but then after it happens, it's like nothing, right? And the same thing as a trader, you're gonna fall, you're gonna fail. So don't let the fear of losing prevent you from following your plan. If you have the right proper risk management, the right proper technique in which you're looking at these trades, ultimately it would lead to success. And I'm definitely one to vouch for that. The other piece that we'll get into is don't average down. And I think we cover that in the next section here. But definitely don't want to average down. I see a lot of the times when you are losing on a particular stock, say you bought it at $3 and now all of a sudden it's down to $2. People tend to add to the $2 mark in hopes that they could split the difference, and if the stock goes from 2 to 2.5, so 2.5, they could then break even and be out of the trade. But in a lot of the cases, a stock that continues to move down will continue going down, in which they add to 2, and then all of a sudden now the price of the stock is $1.50, and then they add again. Now the price of the stock is $1 or 80 cents. Now they just added more to a losing stock and now are more in the hole than they were before. So, or not cutting their losses, right? Not getting out of the trade soon enough, and being like, you know what, I just need to take the L instead of being down just 100 maybe by holding on so long. Going back to sections and parts of this 1 through 4, that exposure risk and so forth can lead to a big piece of that fear and going away from your trading plan. Okay. 6, the impulse to double down. We just cover this again, adding to your losers. You don't add to losers, we add to winners. Okay. That's the only rule you need to know when we talk about this. Don't add to losing stocks. Don't try to average down, double down, none of that shit. Only add to winning stocks. Okay? And again, same concept, add to winners, not losers. And then revenge trading in snowball days. So revenge trading is going to happen at some point in your career. I guarantee it. And you just, 1, need to be able to recognize it, and 2, walk away. I would much rather risk the opportunity of making profit by taking a week break than trying to trade the following day after a big loss in the hopes of trying to make that profit back. I've seen times when traders have lost quite a bit of money, and as a result, the following day they tried to double in hopes of trying to make that money back quick, which only leads them to losing more money. It's much better to just take a day off, in some cases a week, or even I wouldn't go that far of a month, but I have seen it done. I've definitely taken months off at a time now, and the fact that, doing just fine within a couple months in terms of taking profit. But not every day do we need to trade. There's roughly about 250 trading days in a year. Definitely, certainly won't be green on all of those, and most definitely, certainly don't need to trade all of those. And in terms of this slide 7, or this concept 7, where we're talking about revenge trading, is definitely, those are the days, the following days, and even the day of, to just walk away. If you're already down your max on the day, walk away. It wasn't your day to fight, and you just need to close the laptop, walk away, go have yourself a beer or two, or whatever you need to do to de-stress and take your mind off of it. But definitely, most certainly, don't sit there at your laptop and try to take another damn trade. That is going to be a key way to blow up that account, because again, you're going to have the impulse to try to double your position, to try to make that back quick, and that's going to lead to more failure. All right. Definitely take it from me. I've definitely done that from time to time. Not so much now, because when you look at it retrospectively, it's extremely stupid. But it's going to happen. Okay. So just be aware. And a lot of that, again, the fear of loss, right? So you already lost maybe 700 and you're trying to make that back. What you also need to remember is what you trade with should be 100% expendable. It should not be something that you depend on rent for, your mortgage on, your school tuition, whatever the case, to feed your kids or anything like that. There should be 100 expendable money, in which if you lost this money, especially in the way that we manage our risk, if it's less than 1%, in which case we're talking about 0.05 of 0.005 of our total account, it shouldn't matter, right? And if you're sticking to the 1% max loss per day trade based off of your total equity, you will need to do that multiple times before you blow up that account. Okay, so the fear of loss should not be something for you to then add into it and then take a bigger loss. And then again, the fear of missing out. I don't care if I took a big loss today, and that means tomorrow I need to sit out. And in that case, if I need to sit out tomorrow, and all of a sudden there's a stock that shot off and made 80, 90, 100% returns, completely fine. Because you know why? That's not going to be the only stock that makes that, and I'm not going to kick myself over that. I'd rather take the day off and recoup, refocus, and come back stronger following a trading strategy than to try to make back any losses. Okay, that leads to the snowball effect and you blowing up that account. And then number 8, we talked about this already. Following people that don't know what the fuck they're talking about. And excuse my French, but it bothers me a great deal when I see people that are on Twitter, when I see people that are on StockTwits, and within message boards or you name it, that have no idea or sense of how to trade or show proof that they are traders themselves, trying to teach people on how to do so. So just be wary when you are in those. And there are people that do give some solid information, but take everything as something to consider, but definitely do your own due diligence before just taking a trade on anything. Okay, so this is definitely a type of risk that you will see, and this will lead into the psychology of where it's like you could go on the StockTwits, type in a stock ticker, and you see all 15, 20 or so, or even 100 or so people saying that a particular stock is bearish or bullish. You believe that, and then so you buy into that hype, and all of a sudden it goes the opposite way, right? So do your own due diligence, rely on yourself, rely on building a foundation, um, taking courses from people that know what they're talking about. Reading books is the number one great thing that I would recommend, and practicing. Okay, um, putting in bat time is what I call it. Referring back to the baseball analogy I used, I believe in chapter 1. You could read a book on baseball. You could watch videos on people hitting a baseball. You could get a mentor to spend an hour with you once to show you how to hit a baseball, and you could practice with that mentor a couple of times, and maybe during one of those sessions you will hit a baseball a few times. Then come game time, and you strike out 3 times in a row, and you're questioning what the hell? I just read a book, I just watched a video, I just got a mentor and spent a couple of sessions with them. Why am I not hitting? Well, you're not hitting because you're not practicing daily. The same thing here goes with trading. You have to sit there and practice and practice and practice and build a foundation that will then lead to success. And you're not going to do that by copying people on social media, especially those that don't know what the fuck they're talking about. Okay? So I said my piece there on chapter 8, on section 8 here. Then number 9, improper position sizing. So this goes back to that Excel file, understanding how much to go in on a trade so that you stay within your rules in terms of the 1% loss. And if you adjust that position sizing, you better be adjusting not only the percent of that stop loss, but ensuring that you're still within the max and allowed total of what you're willing to lose for that day. Okay, when you start to mess with any of those variables, it can lead to inconsistency. So making sure you're consistent and having that proper position sizing. And again, we talked about if you're using Thinkorswim, it's best to have a $5,000 or above a $4,000 account, and the fact that the difference by sticking to the strict rules we have and the commission fees, it only makes sense to have greater than that 3,000 to 5,000 mark. All right. So very dry topic, very dry chapter. I apologize, but these are all key concepts that you need to know. And all of these, once you go through the first chapters and start to focus in on them again, I highly recommend you do so. Going back and studying what you're learning here. If you're just going chapter to chapter, you're not doing yourselves any service. These are to be built upon each other, but then also for you to go back and watch them. Just going over something once is definitely not enough, in my opinion. And it all goes towards that preparation. Okay, so proper preparation will help lead to the psychology piece that we talked about. The fear of missing out, the fear of losses, the fear of pushing the button. All those things are a result of not being prepared, in my opinion. So the more prepared you are, the more practice that you've had, which goes back into the previous chapters, using a simulator first, following that trading plan, using a simulator before using real money, or if you are using real money, a small amount, so again, that it's expendable. All those things definitely matter. So with that said, this will conclude this chapter. The following chapter, we are going to get into some more back into the fun things. We're going to look at live examples. We're going to look at Thinkorswim again in some detail. We're going to have a little bit of animation for you and talk about stock patterns, both from the candlestick perspective and then in terms of chart patterns that you will see that those candlesticks will display at times, and whether they are bullish, bearish, or something not to consider. Okay, so with that said, that'll conclude the segment for today. Small segment as well, and I'm trying to keep them smaller, anywhere between 30 minutes to an hour, to again just cut through the bullshit and just get to what I think you should know. In this case, there was a little bit of over explanation, but I think it's important to have these examples here, especially for this chapter, because we are going to run into these things, and we may have some similarities that we've seen already on some of the examples that I presented. So with that said, that'll conclude this chapter. I hope you've learned at least a couple of things. I'll see you in the following chapter. And as always, thank you so much for tuning in, for believing in us and trusting us with your trading career. And as always, please do your extra homework and studying on these concepts. And we will see you in the next one. All right. Take care and happy trading.